It's a Tuesday morning, maybe 7:15 a.m., and you're sitting in traffic or crammed into a bus or speed walking through a parking lot, coffee in hand, already mentally rehearsing the meetings you don't want to be in. And somewhere between sipping that coffee and sighing at the slow car in front of you, a thought creeps in. A thought you've probably had before, but today it hits a little differently. What if I didn't have to do this? Not in a dramatic, I'm quitting everything and moving to a beach kind of way. Just what if the money was already coming in? What if you woke up and the bills were covered? Not because you punched in somewhere, but because your investments, your portfolio, your dividends, your rental income were quietly doing the work while you slept? It's such a seductive idea, right? And honestly, most people just let it stay an idea. They file it under things rich people get to experience and go back to their inbox. But here's the thing, and this is what genuinely gets me out of bed every morning, which is kind of ironic given the topic. That crossover point where investment income starts to match and eventually surpass your salary is not some mythological event reserved for hedge fund managers and tech founders. It is an actual mathematical milestone, a real thing. And it has a shape, a timeline, and a set of conditions that most people have never actually sat down and mapped out. My name is Sam, and I spend probably way too much time obsessing over money. Not in the I want a yacht sense, but in the genuine, almost annoying, why does this work the way it does and how can regular people actually use it sense? I've read the boring books, run the spreadsheets, talked to people who have crossed that line and people who are still decades away from it. And what I keep finding is that the gap between dreaming about passive income and actually living off it usually comes down to a handful of concepts that nobody explains clearly, and a few mental traps that almost everyone falls into. So today we're going to map it out. We're going to look at when investment income actually starts to challenge your day job, what that crossover really requires, and maybe most importantly, how to think about your own situation without either crushing your own hopes or sleepwalking into unrealistic expectations. This might genuinely shift how you see the next decade of your financial life. Let's get into it. The crossover point is real, but it's not magic. Okay, so let's start with what we're actually talking about because I think there's a lot of fuzzy thinking around this concept. When people imagine living off investments, they often picture some vague future state. Rich, retired, sipping something cold on a porch. But the actual crossover point, when investment income equals or exceeds your employment income, is not a vibe. It's a number, and you can calculate it. Here's the basic logic. Your investments generate returns. Those returns, whether they come from dividends, rental income, interest, or capital appreciation you systematically sell, represent a dollar amount per year. At some point in your life, that dollar amount equals what your job pays you. That's the crossover. The slightly uncomfortable truth? For most people working normal jobs, this takes a long time. We're usually talking decades, not years. But here's what changes everything. Understanding why it takes that long and which levers actually speed it up. Think of it like a race. Your day job is the hare. Fast, reliable, showing up every 2 weeks with a paycheck. Your investment portfolio is the tortoise. Slow at first, almost embarrassingly slow, but compounding quietly in the background. And at some point, and this is the part that surprises people when they actually model it, the tortoise doesn't just catch up. It surpasses the hare, and then it just keeps pulling ahead, almost effortlessly. The question is just, when does that happen, and what do you do between now and then? The math that nobody talks about, honestly. Let me walk you through the core math here because I think it's both simpler and more humbling than most people expect. Let's say you earn the equivalent of around $60,000 a year from your job. That's your target. That's what your investment portfolio needs to generate annually for you to reach the crossover. Now, a common framework that financial planners have used for decades is called the 4% rule. The basic idea, and I'll simplify slightly here, Dan, is that if you have a diversified investment portfolio, you can withdraw roughly 4% of its value per year without running out of money over a long retirement. It's not a perfect rule, there's a lot of debate around it, but it's a useful starting point. So, if you need $60,000 per year and you can safely draw 4% annually, then the portfolio size you need is $60,000 divided by 0.04, which gives you $1,500,000. $1.5 million. And here's where people either get motivated or quietly close the browser tab. But wait, stay with me. Because there are two things most people miss when they look at that number. First, that's the full replacement number. The crossover doesn't have to mean full replacement right away. Maybe your investments generate $20,000 a year, which means you only need $40,000 from your job. That's still a crossover, that's a partial one, and it gives you options. Maybe you negotiate part-time hours. Maybe you take a lower stress, lower paying role. Maybe you just breathe easier every month because you're not financially desperate. Second, the power of compounding means the timeline to reach that number is not linear. The first $100,000 takes forever. The second $100,000 takes less time. By the time you're in the $800,000 to $1 million range, the investment returns themselves are adding massive chunks annually, often more than you're contributing through savings. The math becomes your ally rather than your enemy. Why the starting amount matters. Way more than you think. Okay, here's something I genuinely didn't appreciate until I actually ran the numbers myself, and it kind of blew my mind a little. The amount you start investing with, and more importantly, when you start, has an almost violent impact on when you reach the crossover. Let me give you two versions of the same person. Let's call them both, let's say Nick and Jack. Nick starts investing at 22. He puts in $300 a month, consistently, into a diversified index fund, averaging roughly 7% annually after inflation. He doesn't earn much, doesn't invest much, but he starts early. Jack waits until he's 32 to get serious. But by 32, Jack has a better job, so he decides to invest $700 a month. More than double what Nick invests, also at 7% annually. By the time they're both 55, Nick wins. Not because he's smarter or earns more, but because he gave compounding 10 extra years of runway. Those early years, when the amounts feel almost embarrassingly small, are disproportionately valuable. The metaphor I keep coming back to is rolling a snowball. In the beginning, the snowball is tiny. You're rolling it across flat ground and it barely picks up snow. But the moment it gets big enough to gather real mass, every rotation adds more than the last. Time is the slope of the hill. The earlier you start rolling, the bigger the snowball gets when you actually need it. So, if you're watching this and you're in your 20s or early 30s, please understand, the right time to start was yesterday, and the second best time is right now. Not when you have more money, not when you've paid off every debt, not when the market feels safe. Now, the income side of the equation. Why your salary matters more than savings rate alone. Now, here's a nuance that I feel like gets lost in a lot of these conversations. Your salary isn't just your enemy in this story. It's also your fuel. A lot of personal finance content focuses almost exclusively on frugality. Cut your lattes, cancel your subscriptions, live on rice and beans. And look, I'm not going to tell you spending habits don't matter because they do. But I think there's a psychological toll to framing the entire journey as deprivation, and it also misses something important. Your savings rate, the percentage of your income that you actually invest, matters enormously. But savings rate is a function of two things: what you spend and what you earn. And for most people, there's a ceiling on how much you can cut expenses. You can only get so lean, but your income? For a lot of people, that ceiling is much higher and much less frequently approached. Here's a genuinely interesting pattern I've noticed when talking to people who've actually reached financial independence, who've crossed that threshold where investment income covers their life. Almost all of them grew their income significantly at some point. They didn't just grind out a savings rate on a stagnant salary, they negotiated raises. They switched jobs. They built a side business. They found a way to increase the fuel going into the engine. The math actually shows this clearly. Compare two scenarios. Someone earning $50,000 who saves 20%, that's $10,000 per year invested. Now compare someone earning $80,000 who saves 25%, that's $20,000 per year invested. The second person isn't just contributing more in absolute terms. They're giving compounding dramatically more to work with every single year. Assuming the same return rate, they'll hit the crossover point potentially a decade earlier. So the lesson here isn't don't worry about spending. The lesson is don't only think about spending. Your income is a lever. Pull it. The role of investment type. Not all returns are created equal. Okay, so we've talked about when the crossover happens conceptually, and we've looked at how savings rate and starting time affect it. But we haven't talked about something that massively affects the experience of passive income, which is, what kind of investment returns are you actually generating? Because here's the thing, not all returns feel the same. Capital appreciation. Where you buy an index fund, it grows and you sell shares to fund your life, is powerful and tax efficient in many situations. But it requires you to sell assets. There's a psychological element to this that's surprisingly uncomfortable for a lot of people, especially early on. You've spent years watching your portfolio grow, and now you have to watch it shrink slightly every time you take a withdrawal. Even if the math says it's fine, it feels wrong. Dividend income, on the other hand, just arrives. You don't have to sell anything. Companies distribute a portion of their earnings to shareholders, and that cash lands in your account. For a lot of people, this feels much more like a salary replacement, something that comes in regularly without requiring action. The downside is that dividend-focused portfolios can sometimes sacrifice growth, and the yields might not be as high as total return strategies. Then there's rental income, which is its own entire universe of complexity. Real estate can generate substantial passive income, but passive is doing a lot of heavy lifting in that sentence. Tenants exist. Maintenance exists. Vacancies exist. Done well, though, real estate can be a remarkably effective path to bridging the gap, especially because leverage, using borrowed money to buy an asset, can dramatically accelerate your exposure to appreciating assets and rental cash flows. And there's fixed income, bonds, REITs, peer lending, which can provide reliable but often more modest returns. The point isn't to tell you which one is best. The point is that your experience of the crossover will be shaped by what your portfolio actually produces and how it produces it. Ideally, most people approaching this kind of independence want a blend. Some growth, some income, some resilience. The phantom crossover. When you think you're there, but you're not. You're not. Here's something a little uncomfortable that I want to be honest about because I think it saves people real pain. There is such a thing as a phantom crossover. This is when the numbers look right, but the timing is off in ways that aren't obvious, and it's more common than people realize. The most typical version looks like this. Someone builds up a solid portfolio and maybe $800,000 to $1 million, and the investment returns in a good year look incredible. The market's up 20%, their portfolio throws off $160,000 to $200,000 on paper, and they think, I'm here. I've crossed over. So they leave their job. And then a correction hits. Maybe the market drops 30%, which is completely normal historically. Their portfolio falls from $1 million to $700,000. Their withdrawal of $50,000 now represents more than 7% of a shrunken portfolio. And suddenly the math doesn't work anymore and they're scrambling, maybe looking for income again. And the psychological damage of that reversal can be really significant. This is called sequence of returns risk, and it's basically the monster under the bed for early retirees. The order in which returns occur matters enormously when you're withdrawing from a portfolio. A 30% drop in year one of your crossover is far more damaging than a 30% drop in year 15. The practical lesson? The crossover isn't a moment, it's a zone. Before you actually declare victory and walk away from employment income, you want to see sustained, realistic returns over a full market cycle. You want a buffer. You want flexibility. The most successful people I've seen navigate this have a 3 to 5 year cash or short-term bond cushion. So they never have to sell equities into a down market just to pay their grocery bill. The tax layer, that changes everything. All right, let's talk about taxes for a second, because this is where a lot of people's mental models completely break down. When you're earning a salary, you pay income tax on every dollar. Depending on where you live, that could be anywhere from modest to genuinely painful. But investment income is often taxed very differently, and in some cases not taxed at all in certain jurisdictions or at certain income levels. In many countries, long-term capital gains, profits from selling assets you've held for more than a year, are taxed at lower rates than ordinary income. Qualified dividends also often get favorable treatment. In some places, if your total income in a given year is below a certain threshold, those gains are taxed at 0%. This is significant. This means that at the crossover point, where your investment income is replacing your salary, your actual tax burden might be substantially lower than it was when you were earning that same amount from employment. So the $60,000 you need from investments might actually go further than the $60,000 you earn from your job because you're keeping more of it. This doesn't mean you ignore taxes in your planning. It means you structure your investments thoughtfully, ideally with guidance from someone who actually understands tax advantage accounts, capital gain strategy, and whatever rules apply in your specific country. But the core insight is the crossover can actually be more favorable than it appears when you factor in the tax efficiency of investment income relative to employment income. What life actually looks like near the crossover. I want to take a moment to humanize this because I think we spend so much time in the math that we forget to talk about what it actually feels like to approach this point. People who are in that middle zone, where investment income is maybe covering 30%, 40%, 50% of their expenses, often describe a very specific shift in how they feel at work. The stakes change. When your job isn't your only lifeline, your relationship with your employer shifts. You negotiate differently. You set limits differently. You can say no to things that conflict with your values or your health because the financial desperation that used to make that feel impossible has been quietly eroded by the portfolio sitting in the background. There's a term in the financial independence community, FU money. It's not elegant, but it describes this concept perfectly. It's not the amount you need to never work again. It's the amount you need to have real options, to be able to walk away from a toxic situation, to take 6 months and figure something out, to start something new without being completely financially naked. And what's fascinating is that this psychological shift often happens way before the full crossover. Even partial investment income, $10,000 a year, $20,000 a year, starts to change your posture in the world. You stop making purely fear-based decisions with your career and your time. That, to me, is one of the most underrated arguments for starting the investment journey early, even when the amounts feel trivial. You're not just building a number, you're building psychological freedom in increments. How to actually map your own crossover timeline. Okay, so let's bring this down to earth. How do you actually figure out your personal crossover timeline? Start with 3 numbers. First, your current annual expenses. Not your income, your actual spending. What does it actually cost you to live your life right now? Be honest. Include everything. Rent or mortgage, food, transport, entertainment, subscriptions, the random stuff you forget about until the card statement arrives. Second, your target passive income. This might be the same as your expenses, or it might be a lower number that represents your enough, the point where you'd have enough investment income to live simply and comfortably, even if not extravagantly. Third, your current investable assets and monthly savings capacity. What's in your investment accounts right now, and how much can you realistically add each month going forward? Once you have those 3 numbers, you can run a compound growth projection. There are free calculators all over the internet, or you can do it in a simple spreadsheet. Plug in a conservative assumed return. I'd suggest somewhere between 5 and 7% annually after inflation for a diversified stock-heavy portfolio. And let the model show you when the portfolio reaches the size that would generate your target passive income at a 4 to 4.5% withdrawal rate. The number that comes out is your personal crossover point. It's not a guarantee. Markets aren't predictable, life isn't linear, but it gives you something real to work toward. And that concreteness is powerful. The uncomfortable accelerants nobody wants to talk about. I'd be doing you a disservice if I wrap this up without mentioning the stuff that actually dramatically accelerates the crossover for most people who get there. Because honestly, it's not always the stuff personal finance YouTube glamorizes. The boring accelerant, increasing your savings rate aggressively during your peak earning years. Not permanently, not forever, just strategically during the periods when your income is highest and your expenses don't have to scale with it. A lot of people let lifestyle inflation quietly swallow every raise they ever receive. The people who hit the crossover early are often the ones who kept their lifestyle relatively stable while their income grew, banking the delta rather than spending it. The uncomfortable accelerant, career optimization. I know it sounds like corporate advice, but hear me out. The single most effective way most people can increase the fuel going into their investment engine is to earn more. That might mean negotiating harder. It might mean switching companies every few years, which statistically tends to increase salary faster than staying loyal. It might mean building a specialized skill that commands a premium in the market. It might mean starting something on the side. I'm not saying sacrifice your life for money. I'm saying the income lever is real and underutilized. The strategic accelerant, tax optimization. Max your tax-advantaged accounts first. Understand what's available to you. whether that's pension contributions, retirement accounts. IS, as if you're in the UK. Tax-sheltered compounding is meaningfully better than taxable compounding over long time horizons. Every dollar that doesn't go to taxes stays in the snowball. And finally, honestly, this one surprises people, the emotional accelerant. Clarity about what enough actually means to you. A lot of people never reach the crossover not because they don't have enough money, but because they keep moving the goalposts. Each time they accumulate more, they decide they need more. The crossover is partly a financial milestone and partly a psychological decision. Knowing what enough looks like for your specific life, not some abstract maximized version of life, makes it much easier to actually recognize when you've arrived. A thought about time that I can't stop coming back to. I think about this a lot, maybe too much. But here's what gets me. Every year you spend with your entire financial life dependent on a single employer is a year where you're essentially running one power line into your house and hoping nothing goes wrong. And I'm not saying employment is bad. Most people need it. Most people will have it for decades. And there's real dignity in building a career and contributing to something. But there's a fragility to it that we normalize and then stop seeing. Your employer can restructure. Industries can shift. Health can change. Life has a way of intervening in timelines. The investment portfolio is a second power line. It doesn't have to be the primary one yet. It just has to exist, growing quietly in the background, becoming more substantial over time, until one day, and this is the day that genuinely changes everything. It's generating enough that the first power line stops being existentially necessary. That's the crossover. Not retirement necessarily. Not laziness, not escape. Just options. Just the ability to choose. Just breathing room in a life that tends to feel, for a lot of people, a little too tight. Getting honest with yourself. Here's what I want to leave you with, because I think it matters more than any specific number or formula. The biggest reason most people never approach the crossover isn't that they can't afford to invest, and it's not that they lack information. There's more financial information available today than at any other point in human history. The biggest reason is that they've never actually sat down and made this concrete for their own life. They've consumed the content, nodded along, felt briefly inspired, and then done nothing different on Monday morning. The crossover is a real thing. It's mathematically achievable for a much larger percentage of people than actually achieve it. And what separates the people who get there from the people who spend 30 years saying they'll start investing soon is almost never a dramatic financial advantage. It's usually just the decision to make it real, to open the account, to set up the automatic transfer, to treat the investment contribution as a non-negotiable bill rather than whatever's left over at the end of the month. Because here's the cold, honest truth about the end-of-month approach. For most people, there is no money left at the end of the month. It expands to fill the space available. Pay yourself first, invest first, live on the rest, and you'll be shocked how quickly the portfolio starts to feel real and how quickly that psychological shift I mentioned starts to kick in. I want to be honest about something. I don't know where you are in this journey. Maybe you're just getting started. Maybe you're 10 years in. Maybe you're close enough to smell it. Whatever your situation, I genuinely believe the single most useful thing this video can do isn't give you exact answers. It's help you ask better questions about your own numbers, your own timeline, your own definition of the crossover. When does investment income finally beat your day job? For some people, it's in their 40s. For some, it's their 50s. For a small group of intensely focused people, it happens in their 30s. For others, a partial crossover, enough to have options, happens much sooner than the full thing. And honestly, that partial crossover might be the most important milestone of all, because the goal was never really about beating your job. It was about building a life where you choose to be there, not because you have to be. Start the snowball, keep it rolling, and don't stop until it's bigger than the hill.